Hello everyone. In this video, we discuss the cost of financial distress. Financial distress occurs when promises to creditors are broken or honored with difficulty. Sometimes financial distress leads to bankruptcy. Sometimes it only means the difficulties the firm faces for the inability to pay the debt on time. Financial distress is costly. Investors know that levered firms may fall into financial distress and they worry about it. That worry is reflected in the current market value of the levered firm securities. And thus, the value of the firm can be broken down into three parts. So far, we already know that market value of a firm is value if all equity finance and then present value of tax shield. Now we introduce this third component, present value of the cost of financial distress. So as we are arguing that since financial distress is costly and investors consider this cost, it has a negative impact on the firm's market value. That's why as long as a firm is debt financed, the market value should be determined by these three components. Look at this diagram where we have the debt in the horizontal axis and the value of the firm in the vertical axis. And you can see that this straight line is the value of unlevered firm, which doesn't changes with the change in debt because that's basically the value of the firm if the firm remains unlevered. Then this is a red line, you can see it's the value of a levered firm. So as you see that as we go from left to right, the amount of debt increases, the value of the firm keeps increasing. You can see it's upward sloping up. So value of the firm keep increasing. The reason that value of the firm keep increasing is as we use greater amount of debt, we get higher tax advantage. So we get the value of this tax shield, which increases the value of the firm. However, we need to understand that as we borrow more and more debt, the cost of financial distress also goes up. Okay, so you can see this is the cost of financial distress. Initially, this cost of financial distress is trivial. It's very minimum. That's why it doesn't affect the value of the firm too much. However, as we keep borrowing, the cost of financial distress goes up, and at some time the cost of this financial distress will be higher than the advantage of this tax shield. So in that case, you can see that up to this level where the value of the firm is maximized, and if we use a debt after this point, the value of the firm will decline because the cost of financial distress will offset the tax advantage. So after that point, it's not beneficial for a firm to use debt anymore. So up to that point, the firm can use debt because the tax advantage is enough to offset the cost of financial distress. So this is known as trade-off theory of capital structure. Now we discuss some conflict of interest between the security holders of a firm. When a firm is in trouble, both bondholders and shareholders want to recover, but in other respects, their interests may be in conflict. Financial distress is costly when these conflicts of interest get in the way of proper operating, investment, and financing decisions. Stockholders are tempted to forsake the usual objective of maximizing the overall market value of the firm and to pursue narrower self-interested goals. They are tempted to play games at the expense of their creditors. So we now illustrate this by this example. You can see here we have a circular file company's book value balance sheet. So we have bonds outstanding, common stock, net working capital, and fixed asset. We assume that there are only one share and one bond outstanding, and the stockholders is also the manager. The bondholder is somebody else. So this is the market value balance sheet you can see in the slide. So you can see clearly that the firm is in financial distress. Okay, the current face value of the debt, you can see, which is $50, its market value is $25. That means the face value of debt exceeds its market value. So if the debt is matured today, it means that the firm has to pay $50 because that's the face value. However, the farms, you can see the value of the total asset is only $30. So if the debt matured today, Circular's owner would default, leaving the farm bankrupt. But suppose that the bond actually matures 1 year from now, hence there is enough cash for Circular to limp along for 1 year, and that's the bondholder cannot call the question and the forced bankruptcy before then. The 1 year grace period explains why the Circular share still has some value. You can see that common stock value is $5. That still has value because the company has a 1 year period. Now, let's say that farm has an option to invest $10. Okay, so it has an investment opportunity. This is a wild gamble and probably a lousy project. But you can see why the owner would be tempted to take it anyway. You can see if you invest $100, there is a 10% probability that the payoff will be $120, and there is a 90% probability that the value of the investment will be $0. Okay, so NPV is $2 negative. So ideally, we should not accept this project because you know that we should accept only those projects that has positive NPV because positive NPV projects add value to farm. However, this project although has a negative NPV, but owners, I mean the shareholders, may be tempted to take it anyway. Okay. So what happens is you can see that as the companies goes for these negative $2 NPV projects, what happens is you can say it's previously it had a net working capital of $20. So from this $20, $10 was used to take this project. Okay, and so its net working capital decreased by $10. And you can see that previously bonds outstanding was $25 and common stock was $5. Now bond outstanding decreases to $20 and common stock increases to $8. Okay. So you understand what's actually happening is the farm's value fall. Previously, if you remember, the farm's value was $30. Okay, farm value was $30. Now, since it's a negative $2 project, the farm's value declined by $2. However, although farm's value declined by $2, actually bonds outstanding declined by $5 and common stock outstanding increases by $3. So what's actually happening is this game has been played at the expense of the Circular's debt holder. Okay, so the game illustrates the point that stockholders of levered firm gain when business risk increases. Financial managers who act strictly in their shareholders' interests will favor risky projects over safe ones. This may even take they may even take risky projects with negative NPVs because that will make shareholders better off compared to bondholders. If you have ever wondered that why common stockholder value was increased, because previously fixed asset was $10, now fixed asset increases to $18. Okay, so the common stockholder gained from the value of this increase in fixed asset. Now, if you look at another option, you can see here that the company has a relatively safer project now, and it's positive NPV project, which is $5. And however, this fund has to brought by additional capital by the shareholders. Okay, now if farm takes this project, this positive $5 NPV project, you can see that net working capital remains the same. That was previously $20. Fixed asset value increases. Bond outstanding, which previously was $25, now increases to $33. And the common stock, which previously was $12, now increases, previously was $5, now it increases to $12. Okay, so what happens is, you invested $10 in this project. Am I right? $10 in this project, and it's a $5 NPV project. Okay, so the farm's value should increase in total by $15 because you invested $10 and the NPV of the project is $5. So farm's value increased by 45, by increased by $15. Previously the value was $30. Now it increased to $45. However, look at how much the bond value has increased. Bond value previously was $25. Now it increases to $33. So it increased by $8. And its stock previously was $5. Now it's $12. So it's $7. So you can see that farm's value increases by $15. However, it has been allocated between debt and equity. Although the fund was raised by the equity holders, I mean, the shareholders raised this additional equity, but the advantage not only accrued to the equity holders, or rather, the greater advantage is accrued to bondholders. Okay, so in these circumstances, although the farm's value was increased, the shareholders will be reluctant to take these projects. It's a good project that's having a good value for the farm, but shareholders will be reluctant because they know that if they raise additional fund and takes this project, the maximum of the benefit will accrue to the debt holders. So these are the conflict of interest between bondholders and equity holders under the circumstances of financial distress, that one party may take the game at the cost of another party, and one party may take, particularly the equity holders, may not take a project even if overall that's beneficial for the farm. Okay, so our example illustrates a general point actually. If we hold business risk constant, any increase in farm value is shared among bondholders and stockholders, you can see. The value of any investment opportunity to the farm shareholders is reduced because project benefits must be shared with bondholders. And thus it may not be in the shareholders' self-interest to contribute fresh equity capital, even if it means that forging positive and foregoing positive NPV investment opportunities. Okay, so this is the theoretical problem explained by this example. This is the last topic today, picking order of the choice of picking order theory of financial choices. These are basically the two main theory of capital structure, trade-off theory and pecking order theory. Trade-off theory already explained by the graph, if you can remember. We have seen that as firm uses more and more debt, the firm's value increases initially because firms get tax advantage. However, as the firm uses more debt, the cost of financial distress also goes up. So firm uses debt up to the point where tax advantage is enough to offset the cost of financial distress. However, if firm uses debt beyond this point, the cost of financial distress will be higher than the tax advantage. That's why the overall value of the firm will be reduced. So that's the reason it's called trade-off theory. You must make a trade-off between the present value of tax shield and the cost of financial distress to determine the optimum level of debt. What we now discuss in this slide is the pecking order theory. The pecking order theory starts with asymmetric information, a fancy term indicating that managers know more about their company's prospects, risk, and values than do outside investors. Managers obviously know more than investors. We can prove that by observing stock price changes caused by announcement by managers. For example, when a company announces an increased regular dividend, the stock price typically rises because investors interpret the increase as a sign of management confidence in future earnings. We discussed about information content of dividend. In other words, the dividend increase transfers information from managers to investors. This can happen if managers know more in the first place. Asymmetric information affects the choice between internal and external financing and between new issue of debt and equity securities. This leads to a pecking order theory in which investment is financed first with internal funds, reinvested earnings primarily, then by new issue of debt, and finally with new issue of equity. That's sort of the pecking order theory. So when a firm wants to invest in a project, the firm should first use internally generated fund that's less expensive in terms of the cost of issuing new shares. And the second alternative is issuing debt, and the third alternative is issuing equity. New equity issues are a last resort when company runs out of debt capacity. That is when the threat of cost of financial distress brings a regular insomnia to existing creditors and to the financial finance manager. Now, the point is why after using internally generated fund, the firms goes for debt rather than for equity. Keep in mind one thing, that if you are a finance manager and if you are very much confident about the success of a project and you know that project will generate a good return compared to your cost of fund, so what do we do? You should not use equity using issuing new shares, bringing additional shareholders to share your profit. So what you would do is you borrow money, take the project and pay out your debt holders, and the rest of the return goes to the shareholders. So when a firm has a very good project, that's the strategy a firm should follow. And that's the reason if firm announces to borrow money to invest in a project, that gives a signal to the investors that firm is using debt for the project. It's indicating this management is very confident about the success of this project. That's why they are even ready to take the riskiness of debt, and they want to use debt because the cost of debt is less than the return generated by this project, and so the excess return goes to the shareholders. However, when a company announces to raise the fund by equities, that gives a negative signal in the market. The reason is investors think that managers are in doubt about the success. That's why they do not borrow money, because they probably is uncertain about their ability to pay out debt, and that's why they are using equity, because they are bringing more shareholders. In any case the project fails, the risk or the losses. Okay. So since issuing debt gives a positive signal in the market and issuing equity gives a negative signal in the market, the managers tend to issue debt when they have a project before they go to issue equity. And that's the reason, as I said, that when there is an announcement that a stock for debt exchange offer, the stock price falls, and when there is an announcement for debt for a stock exchange offers, the stock price generally rises. So when company announces issuing of a debt, that generally have a positive impact on share price, so share price generally goes up. And when company goes to issue equity, that has a negative impact generally on the share price, and share price declines. So these are the actually impacts of the pecking order theory that I have just discussed so far. So firms generally prefer internal finance, and they adapt their target dividend payout ratios to their investment opportunities while trying to avoid sudden changes in dividends. And sticky dividend policies plus unpredictable fluctuations in profitability and investment opportunities mean that internally generated cash flows is sometimes more than capital expenditures and other times less. If it is more, the firms pay off debt or invest in marketable securities. If it is less, the firm first draws down its cash balance or sell its marketable securities. If external financing is required, firms issue safest security first. That is, they start with debt and then possibly hybrid securities as convertible bonds, and then perhaps equity as a last resort. So that's what I am discussing so far. So that's the end of this chapter. Please watch the next video for our discussion on chapter 19. Thank you very much.